Alphabet is scheduled to report third quarter 2024 financial results after the markets close on Tuesday, October 29th. That has investors asking if they should buy Alphabet stock before the company announces those earnings results or after the company announces those earnings results. Now, zooming out a bit, I've had Alphabet stock rated as my top stock to buy here in 2024, and it's done reasonably well so far this year. But whether or not you should buy before or after earnings, I try to discourage investors from thinking short-term nature like that, trying to time the market before or after. Generally, I tell investors to take their investment allocation, split it up in different pieces, maybe in two pieces, and buy half before and half after. In some rare cases, I do feel that companies are undervalued so much that it does make sense to buy ahead of earnings. And in some cases, I feel companies are so overvalued that you shouldn't be buying ahead of earnings anyways. But let's take a look at Alphabet, and I'll answer whether or not I think this is one case where I feel it's so undervalued that you can just make your entire allocation before the company announces earnings. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So in its latest quarterly release, which was for its second quarter 2024 financial results, and this was released on July 23rd, 2024, you can find this document on Alphabet's investor relations webpage. The company CEO said that their strong performance this quarter highlights their ongoing strength in their search business and the momentum in the cloud business. He says that they are innovating at every layer of the artificial intelligence stack. So while Alphabet got off to a late start in the AI race, it has made significant strides in that area. It still might be behind OpenAI and ChatGPT, but it's making reasonable efforts. It's making progress forward. It is benefiting from the rising effectiveness of AI in several different business categories. The company's CFO then jumps on to say that as we invest to support our highest growth opportunities, which is artificial intelligence, we remain committed to creating investment capacity with our ongoing work to durably re-engineer our cost base. So in order to free up the capital to invest in artificial intelligence, Alphabet has made several cost-cutting moves to free up those efforts. You'll recall in late 2022 and early 2023, Alphabet cut over 10,000 jobs in a meaningful cost-cutting effort. And so those lower expense totals, those lower headcounts, allowed Alphabet room to invest in artificial intelligence, which for Alphabet has been primarily on the hardware side, on the data center side, which I'll share with you in a little bit. The company's revenue in the quarter that ended on June 30th, 2024, increased by 14% year over year. That's double the rate of growth that it experienced in the same quarter in 2023 at just 7%. The increase in revenue also increased its operating profitability, jumping from 29% operating profit margin up to 32% operating profit margin. And this comes despite the company's significant investments in other categories and development categories to drive growth in innovative areas. And still, it generates a 32% operating profit margin. And that goes to demonstrate just how lucrative Alphabet's business model is. It's a very high profit margin business, and that allows the company significant cash flow to invest in moonshots, which sometimes the company has been blamed for doing too much investment in these newer, innovative, unproven categories. But at least one of them is proving to be reasonably successful, and that is the driverless car unit. Waymo is doing thousands of rides, driverless rides per week as we speak. I see them on the roads all the time here in Los Angeles, and they're even more popular in San Francisco. And this comes while Tesla is still trying to make announcements and promises about driverless cars in sometime in 2027. Alphabet is already out there with Waymo offering driverless rides every single day. And so it's leading in that category. And so investors that are interested in driverless car technology, Alphabet is a reasonable choice they are exposed to that category with their Waymo segment. I highlighted the job cutting efforts, and you can see here the number of employees year over year. They had 181,800 in the same quarter, June 30th last year. That's now down to 179,582. The bulk of the job cuts happened earlier in 2023. So if you're comparing the June 30, 2024 numbers with, let's say, January 30, 2023 numbers, that would show a considerably bigger decline in employee count. And you can see here that they've continued the discipline in controlling how many employees they hire. Prior to those cost disciplines, those cost-cutting measures, I felt Alphabet was a little bit too loosey-goosey with their expenses. They were hiring people and giving them lucrative jobs and lucrative prospects. And you heard rumors that these employees at Alphabet were hardly given any work to do, but the company was just hiring talent just to have them there just in case and to keep them away from competitors. And now, industry-wide, they've gotten more serious about controlling headcount and keeping costs under control. It's not just Alphabet, but Meta platforms, Microsoft, Amazon, etc. The tech space has gotten more disciplined in terms of cost control, and that's been good for the industry overall, not just Alphabet. So I highlighted that the company's making big investments in hardware, in tech, and primarily to the AI optimized data centers as it's updating and upgrading its data centers from a decade ago that are now seeing an opportunity to get a better total cost of ownership. You can see Alphabet has a lot of cash on the balance sheet, and for many years, investors were complaining that the company is just hoarding all this cash and just putting it into savings accounts, and investors were saying, why are you doing that? If you're just going to put our money in a savings account, why don't you just pay it all back to investors if you don't have anything to do with it? Well, now Alphabet does have something to do with it. It's investing in artificial intelligence. And now I hear complaints from investors saying, well, you're spending too much on artificial intelligence. I disagree with that. I think that Alphabet has proven reasonably good at allocating capital, and they've been reasonably conservative in allocating capital, at least with the capital expenditures, right? They haven't been very good on the expense side with headcount, as I highlighted earlier, but in terms of capital expenditures, they've been pretty disciplined. So as an investor, I do own Alphabet shares. I am happy to see them find opportunities to allocate that capital. And you can see here from December 31st, 2023 to June 30th, 2024, they've added roughly $17 billion in property and equipment. And for Alphabet, the vast majority of this property and equipment is data centers, right? And they have plenty of money to use to do that, right? They got $110 billion as of December 31st, 2023 of cash and marketable securities that were just sitting around. Now that's down to $100 billion. So they use $10 billion of that. And then, of course, the business itself generates so much cash flow from operations that they can allocate some of that to these investments in artificial intelligence, which as an investor, you like to see that from a company that's proven successful at doing it, right? If it's a company that's not good at allocating capital, right? If I was looking at, let's say, AMC Theaters, they've been proven so unsuccessful at allocating capital. They're proven so unsuccessful at innovating the business. You haven't seen anything innovative from that company, and their capital has been spent inefficiently. You don't want to see them spend more money on the business. You just want to see them get the business to generate cash flow and then give that cash flow back to investors and try and shrink the business, because people are not going to movies as much as they were 10 years ago, and that's never going to change. Going to the movies has become so expensive compared to other entertainment options that it's just not something that people are going to do again. And so with that kind of business, you don't want to see them spend money. But with a business like Alphabet, a lucrative business model, proven successful at allocating capital, you like to see them find things to do with the money. And it's good news to see them investing in these AI optimized data centers. All right, so should you buy the stock before the earnings release? Well, it's trading at a forward price to earnings of 19, which is still very cheap for this company with this kind of prospect. at this kind of business model with this kind of market share and competitive advantage, it's still an attractive valuation. So I still have Alphabet rated as my top stock to buy. As you can see here, it's my top rated stock. And of course, it's on my list of top 25 stocks to buy. And I last updated that on September 1st. I still think it's the top stock to buy right now, given the risk versus reward you have available with Alphabet stock. That being said, I don't see a major catalyst that's going to have Alphabet stock price surge following the earnings release. So I don't see very much risk to the upside for investors. Also, I don't see very much risk to the downside for investors. I see it as equally weighted on both sides of this equation here. You have the risk of missing out if you don't buy ahead of earnings. You also have the risk of buying ahead of earnings and then the stock falling by 17%, as we saw with ASML a couple of days ago, right? That was a prime example of why it pays to buy a little bit before and a little bit after earnings, because if there's a big drop like ASML, you allocate half of your investment at that lower valuation. Half, of course, you already invested, so you lose out on the 17% of your initial investment. But at least on the second half of your investment, you get to have that at a 17% lower valuation. And I would recommend the same thing here with Alphabet. Given the equally weighted upside and downside, I would say split your investment in half, by half before and half after the earnings release. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.